Good morning, everyone. We are back finally with the one, the only Jay Pestrichelli of Title, the Chief Trading Officer. And guess what? Special guest. I'm hearing myself echo. It went away. Special guest, the MSTY Fund Manager. His name is there, Scott Snyder. So I just want to thank both of them right away, for joining this, having, a live stream together. We're going to talk mainly about MSTY and all of the things, but I just want to give them the floor. Scott obviously can introduce himself. You guys may not be familiar with him. And then obviously Jay, maybe want to get some things out there. It's been a while since we spoke. Social media has been running rampant. MSTY groups everywhere. Everyone's talking about YieldMax. So I'll let you guys have the floor and we'll go from there.
Yeah, thanks, Rod. Look, you were always an early adopter of talking about MSTY, right? So you fall into the OG camp on this one for sure. I again appreciate you having us on here. Love talking to the community about the fund. Obviously, things have been, going pretty well with this particular fund, but YieldMax in general has been doing well. I think broader adoption has continued. It's funny. Before, just this morning, Scott and I were talking about creation size. That's a weird term. Like the number of net buyers or sellers of the funds through the downturn in April and then the upturn in the last few weeks. And throughout all of it, they've been fairly consistent, right? I mean, I know you watch AUM size, but also watching the outstanding share count is something that also matters. And that has been pretty consistent growth across really all the names, whether it could have been NVIDIA, Tesla, Coney, MSTY. So it's all been, the community continues to be really supportive. So we're thanks for that opportunity to be here and talk to everybody today. And I love, watching the live stream and getting the live questions. So I'm sure we'll touch on a lot today. I thought maybe, because you continue to grow as well, right? Your viewers and your subscribers continue to grow too. So maybe for those that don't know the whole story on this, right? YieldMax and we're talking specifically today about MSTY is about income first, upside capture second. Scott and the team have been doing an outstanding, actually pretty amazing job of being able to deliver on both of those in the middle of has MicroStrategy doubled, Scott, in the last month and a half, 2 months, right? It's gone from those 200s and we're knocking on the mid 400s now. This has been an environment that's, you could say, is challenging for covered calls because what is the deal, right? You usually give up the upside in lieu of cash that we have then distributed as part of the distribution strategy when it comes to MSTY. And to continue to have returns that have captured a significant amount of the upside has just been really, we've been really happy with that. It won't always go this way, right? But it has been a good, let's call it 6 weeks, 8 weeks on the run there. So I'm happy to hop into the questions right away. Scott, actually, I was hoping you could maybe help explain to the community a little bit about the misconception around the idea of the synthetic stock, right? Synthetic stock is when we're long a call and short a put at the same strike, and that replicates the movement of the stock. And I think you thought it was important the community had an understanding of doesn't really matter which strike, right? That 100 delta position, which is long call short put together, always kind of moves in concert with the stock. Maybe you give a little more detail to everybody here, Scott.
Yeah, for sure. And thanks for having me, Mark. It's a pleasure to be here. I do listen to your stream a bunch. I love it. It's great. Love the comments. I'm happy to be here. So thank you, everyone. So I just wanted to talk a little bit about the synthetic combo and what that really is. And that is designed because we can't own the underlying. It's designed to move one for one with MSTR. So you guys would notice a couple of weeks ago when MSTR was trading in the mid 250s, 270, 280, and we had the 330 strike combo on. We get create redeems every day. People taking money out, putting more money with us. So we have to add or subtract to that combo. So when we have a 330 strike combo on and the stock's trading around 270, wherever the stock is, it's pretty much irrelevant. We're going to continue to add to the existing combo that we have. And that doesn't mean that the stock has to go up to 330 for that to be profitable. If the stock's trading 285, we get new money. We continue to add to that 330 combo. It's buying the stock at 285. So even though we're adding to the 330 combo, we're buying the stock where it is at that time of execution. So the The combos, they are going to move one for one with the stock, but the strike price of the combo is pretty much irrelevant for the profitability of the fund. So we established one pretty much close to at the money at the time that we established it. But after that, the movement will just mirror MSTR, and it is what it is after up or down. And that should move one for one. It will move one for one with MSTR. But the strike price itself, like right now, I could initiate a 200 strike price to go long or a 600 strike price to go long, and it's not going to affect the NAV of the fund one bit. It will only affect the NAV based on MSTR's underlying stock price, and that's it. I
And it's
think
not going to affect it because you're always in it. You're always in the position, right? All the contracts are in a synthetic position, right? It's not like you're selling out of one and not opening the new. You're always going to be in it at one strike price or another. And I wanted to just because again, I get a lot of comments about, oh, they should have closed out the synthetic today. They would have made so much money. So I want to let you to speak on that it doesn't matter, right? Whether you sold it today or whether you sold it tomorrow, it doesn't matter because you would have sold it and opened a new position, and then the upward movement obviously would have helped, or downward movement would have been the same, right?
That's exactly right. So if somebody says that we should close that synthetic, then we'll no longer have a position in MSTR. So we'll never close those positions. We'll always roll them. And what strike we roll them to, it's just where the stock is trading at the time we're rolling. That's it. There's nothing scientific to it. It doesn't mean that we're bullish or bearish or anything like that. It's just to move out our combo out in time. So we can never sell that synthetic. We're always going to have it on. So that's the core of the position besides selling the weekly calls.
Yeah, and if I could add, there is one small advantage with the combos over long stock, right? We probably talked about this in the past, but let's just say we had those 330s and now we got to roll them. If you're going to roll them this week, Scott, to say 430s, right? You'd be like, well, what you generated all this cash, right? If you rolled the stock up for all of those points as you move all the way up the scale, you're going to generate a bunch of cash. By the way, that helps pay for cash we needed to cover by calls that were in the money. So if you're normally trading like in your own account and you're just long stock and you sell calls on MSTR and it goes through your strikes, let's say you sold at the 400s and now you got to pay $25 I think that's where it's trading to get out of it. You would have to either put in cash to cover that, carry a margin balance, or sell stock to pay for that, right? You'd sell a few shares and that would pay for your debit. Well, the beauty of, so anybody who's run a covered call strategy, you know that, right? It runs up, you need the cash, got to sell a few shares, you close your calls, sell a few less calls because you have less shares. With the combo, rolling up the strikes, we call it jelly rolling, right? It actually generates the cash we need to cover the call, and we keep all the same long stock exposure, meaning we don't reduce the contracts, right? So actually, it allows you to continue to capture, that same upside with the same number of shares. Whereas if we were just long stock, you'd have a little less stock on the way up. So there is an advantage with the combo. The downside of the combo is every, 3 months, 2 months, we got to roll these things with the options for all of other rules there. So we're actually creating extra trades that maybe you wouldn't have to do if you were long stock, but it's an ETF and you get all the tax advantages here. So it's less of a problem. But if you're a home gamer doing your own combos, realize you're going to have some realized gains when that happens. Just a few little added pieces there.
I was going to say the thing that does matter, right, is when you actually make money, right? Because you have to, that's realized income that will have to be paid out at 90% in the fiscal year, depending on the losses, obviously. But
right now we have that 390 combo on. We could roll it up to the it was 420 before, it's 410 now, but there's no need to just to get those execution costs in, because it does cost the fund a little bit to execute those all the time. So we don't want to continue to move those up and down as the stock's moving. I'd like to touch those as little as possible, actually, the combos.
Yeah.
We
put them on for a year if we could. But ETF rules and concentration stuff.
And that's a good segue because, Scott, we talked about this, right? And this was, again, I had to dissect this for a while, but I finally got it. But I'll let you. So everyone always asks, and I was always busting balls about this in the beginning. why are you guys only going out a month, right? Why are you only going out 2 months? Why don't you go out 6 months to a year so we don't have to worry about the synthetic? So can you guys, one of you?
I'll let Jay explain that because that's the concentration rule. So I'll let Jay explain that.
Yeah, it's an ETF regulation. It's actually the most boring reason in the world. I wish it was some kind of fun, sophisticated trading answer. It's not. It's every quarter an ETF gets tested for the level of concentration it has exposed to any issuer, meaning any symbol. So it could be the long stock, short options, long options. You add it all together. If that number, the absolute value of number, exceeds 25%, you would be considered over concentrated. And so if you go out a year on MSTR options, there's so much juice in the puts and the calls, even though you're still 100 delta, the two positions are additive. They don't offset each other. So when you do the math on it, all of a sudden you're like, oh, now you're 40% concentrated on the MSTR options. But if you do it for 1 month, and this is why it's kind of a silly rule, but if you do it for 1 month, oh, it's only 10% because all the premiums are lower. It's just managing the regulation of ETFs. I wish there was something more fun and interesting about it. It's not.
Yeah, but at least we know now, right? Because at first it's like,
well, yeah, but how would you know 40 Act rules, right? It's not something like I didn't know. I was an advisor for 12 years before we started launching ETFs. I didn't know that. I didn't care, right? It just happens. Look, this is so unique. It's one of the cool things about YieldMax, right? They're so unique and new that a lot of people are learning as you go. Like if you look at SPY, nobody cares. You'll never be concentrated in SPY. I mean, unless NVIDIA really becomes 25% of the index. Obviously, that's not happening. But my point is, you never had to really pay attention to these as an ETF investor in the past, and now the nuances of single stock ETFs is starting to come in play, and you have an understanding of it all. So, yep, it's again regulation. I wish it was more interesting than that.
Yeah, no, but there's obviously a reason, and I know. So you really can't go like, would you say you probably could go out 2 or 3? It's just not worth it, right? Because you could be violating.
Yeah, you just have to close it. So by the way, that concentration test happens once a quarter. So it doesn't have to be every day, just once a quarter. You got to make sure you're ensuring that you're not over leveraged there. So look, you will drift. By the way, you're allowed to drift higher if the stock goes up. It's okay as long as new positions aren't getting added, right? But we know money's coming in and out all the time with this one, so we manage it. So you could drift higher. You just got to bring it down once a quarter.
It was one of the first questions I asked Jay when I started looking into the makeup of the funds. Why? The exact same question.
Yeah, that's good. I know. Real quick, I'm gonna ask the community to start asking questions. I'm not gonna go backwards like I usually do this time because I'll drive myself nuts because we have at least 400 people. We can get the questions live. But Scott, you didn't get a chance to introduce yourself and background, if you don't mind. Okay. People, I think you have an impressive background, right? You've been around and have a lot of experience. So people would be interested to hear it because Misty, it's a big community, and all eyes on you now. So
no pressure. But no, my background is pretty much all options my entire life. So I started on the floor of the CBOE trading as an independent market maker in 1983. And I was trading down there from 1983 till 2003. I was trading only my own capital. So, I wasn't backed by any firms. I was an independent market maker trading in 1987 during the crash. I was trading in the OEX, the busiest option pit in the world. And I would float around the trading floor and trade all mergers. I liked merger acquisitions. So I did that for 20 years. I actually also owned a DPM, which is a designated primary market maker. We had the Amazon, WorldCom, National Semi, AIG. That was my pit. We were responsible for making markets in that pit. So then I left the floor in 2002. A good friend of mine who started Thinkorswim, who I was partners with on the floor for many years. We had a lot of ventures together. I went to work for him, and I started an advisory for Thinkorswim Advisors, where I was trading for retail public. And then TD Ameritrade came in 2009, bought Thinkorswim, and that's how I met Jay. Jay was a platform advisor on the TDA platform, and during the merger, we became friendly and we just kept in touch. I was running the institutional side of TD Ameritrade's trading, options trading, and met Jay, kept in touch with him. And then Schwab ended up coming in and buying TD, and I stayed around for that merger. And I was still helping out advisors trade options, education, running a platform that options are traded over for advisors. And Jay and I just finally hooked up and was telling me all about the YieldMax. And I had always known what Jay has done because we've kept in touch for the last 10 years. And we finally just got together. So I came over last June to Zega, now Title. And that's my background. Yeah, it's all options all the time.
Options, baby. All right.
Yeah, Mark, you're not going to find a lot of guys that were trading in the pits that are still trading today during the 87 crash, right? Scott brings so much experience. I've always found him to be just an amazing trader, and I couldn't be happier to have him.
Don't let him retire anytime soon, right? We need
Let me tell you something. I chased Scott. He's not joking. I chased Scott for 10 years before he finally came over.
You got him.
Finally got him here, and he's happy here. I know he's happy. We're all happy.
Couldn't be happier.
You gave him a good one too in Misty, but no, thank you for the background real quick. So we'll get to some audience questions if you guys are good with that.
Sure.
Here's a member question. Didn't even look at it. Let's see. How does the massive increasing size of the fund affect what you do? How concerning is the increasing size to you? This comes up a lot, actually. I think concern meaning like, is there any trades left, right? Like, because you're making so many trades on MSTR, right? Is there any concern you can get too big?
So, yeah, I'll start, Scott, and then I'll hand it over to you how you manage it. Yeah, and look, MicroStrategy, now just strategy is a name, right? It's a $100 billion stock, right? So there's only so many derivative funds you could jam into the options market and the swap market on it, right? Misty is 3.5, soon to be 4 billion. There's a few other, like we just launched MST, MSTX is also a title. There's other folks that have MicroStrategy based funds. We even have an inverse, right? Winter, WNTR. I think that one gets definitely overshadowed by MSTY. But there's a point, you're right, where concentration limits start to kick in, not the same ones we talked about before, but even just position limits when it comes to that. So, we will be active in managing the portfolio by means of prospectus. So what do I mean by that? Like, we can't have a $50 billion fund on a $100 billion stock, right? It's just way too much, right? So you have to start to spread it out a little bit. And so there's plenty of choices here of how we could start expanding it a little bit, just kind of pushing the edges, get maybe a little more direct Bitcoin exposure into the fund. There's no plan for it today. We haven't filed for any changes on that today. But you're right, there is, I'm not worried so much about the option trades. Like, the market is there. Like Scott will tell you, there's always somebody to take the trade, right? You're not going to run out of trades. There's more liquidity in this, the options on this ticker than we need today. But it's more about what happens when the fund becomes such a big piece. Now you're talking a structure change. Now you're talking a prospectus change. Heck, maybe you split it into two. I don't know. I don't know if we've done some funds have done this. So JP Morgan years and years ago had some of their hedged equity funds that just got too big. And they said, okay, we're just going to start a new one, right? Like, that can happen, right? There's ways to manage through this, but it's something we're paying attention to. So, Scott, why don't you tell the people a little more about kind of how, obviously you don't have to go into all the details, but maybe a little more about how you source liquidity, where you go, where you find it, how many different brokers you trade with. I think everybody would find that.
So it's a great question, and I'm not concerned at all with the size. The market is deep. So with MSTR, we use the trading platform Bloomberg, and we go to the big market makers like Citadel, Susquehanna, Jane Street, Old Mission. There's a bunch of them, and we do competitive risk quotes, meaning that we have all of the biggest market makers and funds in the world competing against each other to give us best price. So I'll enter an order, and 5 or 6 different firms will give me a price. And then whoever gives me that best price, I will take. And sometimes if I don't like any of the prices, I won't take any of them, and I'll just work it myself in the open market through some algorithms that the platform has. But 90% of the time, they're all competing against each other, but they are also our partners in this. They want to fill these orders. They want the trades. They want to give us best X. There is best execution requirements that we are obligated to. So managing the positions, though, we spread that out over, listen, we never know when we're going to have to touch a position. So we know on Friday that we're going to have to for sure, no matter what. But up until then, we don't know if we're going to have to cover. If there comes a time where we have to cover, usually I will split the orders up. I don't want to put in an order that's too big, and maybe that won't be advantageous for our price. So I might break it up into 2 or 3 separate orders over the course of a couple minutes. That's all. And then maybe work orders throughout the day for a couple hours. But the size is very large, but it's not an issue at all.
Okay.
There's plenty of liquidity.
That's good to hear. And not that I want to bring this question up, but can we please put this to bed? Because everyone keeps asking it. Is MSTY ever going to pay weekly?
I mean, never say never, but there's like no intention to change MSTY to weekly. Look, I mean,
never right now. Yeah.
Never say never, right? You don't know, like it all depends. But for now, like the every 4 weeks works pretty well because like the volatility on this on the ticker changes so rapidly, right? Like it was dropping. If you watch a chart of the implied volatility of MSTR, you'll see it moves around quite a bit, right? So I'd prefer I like the smoothing of a 4 week period, right? A little more predictable. By the way, the options market makers on MSTY, right? So this is not MSTR, but the options on MSTY very much prefer the 4 week period and a smooth period, right? They could track that because they've got to guess, right? They have to make an estimate of what the dividends are going to be. So they also would appreciate a longer period and a smoother period and less, spikes and dips. Now, that being said, last week, that distribution was, one of our higher ones. It was really, really well received in the marketplace. But, again, it was some upside capture was in there. And we've talked about that in the past, how some of that we're going to distribute when the underlying does produce quite a bit of gains. But there's no near-term change. None of the single stock YieldMaxes have been filed or stickered to go to weekly yet. Okay. Do people prefer the weekly? Do they want a weekly on MSTY or no?
Well, they just got MST, right? So that pays weekly. Maybe they're satisfied with that. I don't know.
Yeah.
I just keep hearing people say, I heard MSTY is paying weekly. And
where are they hearing?
Not me.
Someone's inside the business meeting.
I don't want it to be weekly. I have a feeling that's going to complicate the fund even more. But,
well, because you have to make the like when we moved to weekly on, say, Alti, for example, right? It didn't make it harder to put on positions because you have to have cash available for the distribution once a week, right? So sometimes you end up closing a trade a little earlier than you might want to because you got to come up with the cash, right? A profitable trade, or it's like, we'd like this thing to run another couple of days, let the time value decline. So it can be a little challenging with the weekly. So my preference is to leave it every 4 weeks, but we'll see. I'm not the only one making the business decisions on YieldMax.
Yeah. Sorry, Scott. You had to mention that.
Yeah, so just changing topics, if that's okay. So Life of Dividends asked a question about trade performance expectations, matrix for the fund managers when it comes to the percentage of win-loss trades within a month, quarter, annually. And, I hear you talk about win-loss trades. So, I think that's a good one to address. And here's my take on that. So we put on trades and we pick strike prices based on where the underlying of MSTR is. And being an owner of the fund, you want MSTR to go up all the time. The only way, unless it goes sideways, that would be the best. But really, we want it to appreciate and go up. So ideally, it would always just go up to our short strike price and sit there. But that's not realistic. The other best scenario would be for that just to keep blowing through our strike prices and have all our trades be losses. And that's okay because the underlying is going to continue to appreciate. And we will continue to manage best we can those strike prices when they go in the money to continue to try to provide as much premium as possible to pay out the dividends and capture the most upside appreciation possible. So we're threading that needle between trying to capture as much premium as we can while getting the upside NAV appreciation. So the win-loss percentage really doesn't make a difference because if I could lose on every trade and have the fund continue to appreciate. Jay's about to interrupt me, so yeah, go ahead.
No, you're good. You're there. You're good.
That would be fine with me.
Yeah,
that would be totally fine with me. Because my goal is to get the NAV up while returning the income that we're creating with the short premium.
Well, I think I explained this to Life of Dividends too. I'm partially to blame for that win-loss thing because I tried to do it like when you had the credit call spreads together. I tried to do it as one trade, right? But then you kind of were adding, the long call, the buy call later on, right? So that was separate, and now that counts as a loss, which in reality, it's never, it's not really a loss, on its own per se. So I'm about to delete that statistic.
It's okay. I mean, it's a good question.
No, it is. It is. And you answered it well, but I'm just saying, like, my numbers on the sheet are a little skewed, and I'm not a fan of that tracking anymore. When it was without the credit call spreads, obviously a little easier and it makes sense. But now, your Misty trades all over the place and trying to keep them as one, but it's a little hard. So I just wanted to, because that's where you got the number. So yeah, I'll admit that part. All right. I wanted to bring this up because this is a very popular topic. Return of capital. So I don't think you used to have it on the email, like the distribution email. I believe you have it now on everything. So of course it's a popular topic, and I know it's an estimate, which I always try to explain to people, but how do you actually calculate the return of capital for that month?
So I'll answer two things about return of capital. First off, that happens in the accounting area, right? That's not what Scott and I do. We do the trades. We'll let somebody else do all the accounting and reporting on it. But I'll give you the general idea of how it even occurs in the first place. So then maybe that'll answer, how we have an idea. So first off, we were forced by regulators to put that in those notifications. They wanted return of capital to be something we called out. But even we're like, you have to use the same font as you do with the SEC yield and the distribution rate. So the regulators are very much paying attention to return of capital, but unfortunately, it doesn't really matter. And here's why it doesn't matter. This is not like a stock fund or a bond fund that is returning capital for gains that weren't earned, right? Return of capital occurs in options-based funds. And by the way, has always occurred in options-based funds when you have realized losses on a trade, not realized gains and losses in the fund. So what do I mean by that? Let's say Misty's trading at 300 or MSTR is trading at 300 and I sell the 320s, right? And I sell that for $5. Well, if MSTR goes up to 330, it's going to cost me $10 to get out of that. So I sold it for $5, bought it back for 10. That's a losing trade of $5. If we were to distribute the original time premium we earned, that original $5, because the trade was actually a loss, even though we made money, stock went up, the fund appreciated, but the actual realized gain was a loss, that distribution will be counted as a return of capital, right? 100% return of capital in that scenario. But it's good, right? Like market went up, fund made money. Yes, we had a realized loss in the trade. And until we roll the synthetic, that's going to remain a loss. Now, by the end, so what we have to do is that estimate percentage is, well, by the end of the fiscal year, tell us what you think the net gain and loss will be. So we're doing these 1 month, 4 week estimates on return of capital, but you could have at the end of the year one massive gain on a rolling of a synthetic, wipes out all the realized losses for the year, and then you have no return of capital, right? It's a misnomer. I know a lot of people are like, oh, you're just getting your money back. That's absolutely not true. You're not just getting your money back. You're getting the time decay that we sold the options for. And we're pretty rigorous about defining that and defending that number because, we know the rate that we sold, right? Like, let's say, for example, Scott last week sold for 1.75%. Let's just say that was his number. We know what the time premium was when the trade was put on. Great. That's going to define the distribution rate. So I know you do some estimates on how much the distribution rate is going to be. Always start with what the time premium is, because for sure that we know we're earning that. We know that's happening. Whether the fund goes up or down doesn't matter. We know we're earning that time decay. I put it on today. By Friday PM, 4 o'clock, that's 0 time decay. We know we made that. So you're not just getting back your money. It's a little annoying to hear, the misinformation about that one out there, but you're really not. And actually, you get a tax advantage if the dividends are classified as return of capital. So I don't know why you wouldn't want it in the first place.
So
Sorry if I got a little emotional, a little heated on that one.
no,
Frank, it's annoying.
it's everyone. That's a popular on the hate side of YieldMax, right?
Yeah.
You're only getting your money back. That's. I had to laugh because I hear that all the time, and
Have you done the math on how much you've gotten back in distributions on MSTY since it was launched?
Well, MSTY, I didn't look at last year's, but I'm pretty sure there was no return of capital, right? Because they didn't.
Because we had that big run up, right.
Yeah. This year, there's going to be, right? Because there's a lot of down months. Obviously, Bitcoin did go down. But I was going to ask,
maybe
you do it 4 weeks, or are you looking at the whole fiscal year? Like, are you going backwards and saying, we have these losses, so we can use them against this?
Yeah. So again, I'll go back to, so when you look at the actual, there's a form that gets posted every single month when we have a return of capital on the website. It's a 19A-1 form. It doesn't matter. It's in the tax supplement section. And that'll give you both the 1 month number and then the year-to-date number, right? So you can kind of get both of those. The part that's hard is as an individual investor, which I agree, this is hard. I don't love that this is the way the numbers are put out there. Our fiscal year is not the calendar year. We pay taxes on a calendar year as traders. The fund pays on I think it ends at the end of October. So it's a little hard to still kind of estimate what it'll be, but you have each one of those months and you have the numbers in those, and they'll kind of give you the totals, right? The other thing about it is as the fund grows larger, the 4-week distribution, this last week was much bigger on a percentage basis or same percentage, but dollar basis than it was, let's call it in January or even like a year ago, right? So that return of capital is also an absolute dollar number as well, right? So, you're an accounting guy, you get all the moving parts there. It's a little difficult. Just do it in an IRA. You don't care about any of this stuff.
No, I use it to pay my bills. Come on.
Okay,
all right, time for a fun question. Scott, do you enjoy my singing?
I look forward to it. I wake up every morning, and I'm an early riser, so I got to wait for him because I'm up earlier than he starts. But the singing gets me out of bed.
You don't mute it like everyone else?
No, I like it.
Jay may have stopped watching because of the singing, but
it's my fave.
Yeah. All right. So this question comes up too, obviously, when I do the estimates, and I always assume it's the day prior to the declaration morning, right? You guys are working late the night before, right? Just figuring out what that number is, and you have it right for the morning after. I don't know. Is that when final distribution is decided, the day before declaration date?
2 days. Yeah. So we're gonna do the math actually right after this call, right, for last week, right? So we'll take the trades from last week, because it's a Monday. So we'll take through Friday. We'll take a look, and then we'll determine what the distribution rate will be. Now then there's you have to file that with the exchanges and those kind of things. Then we got to run it through accounting. So that Wednesday announcement, the math is really done today on a Monday for the previous week. So there's always a little bit of a lag, and then you get paid, right? Then you go ex-div on Thursday, and you get paid on Friday. But yeah, and by the way, that's about the tightest time frame anybody does it. When you look at some of our competitors, it's a much longer time frame between the actual, when the trading occurred and when the actual distribution and dividend gets defined. But we try to do it as fast as possible. It's about as quick as it can get done.
So you cut off at Friday?
Cut off at Friday.
It's included. Friday's included.
Friday's in. Yeah. So on Monday, we look up through
so me adding, well, technically I do my estimate as of the weekend of that Friday. So it's been working out then. So, but I always.
Yeah. And again, that's a 4-week period, although the weeklies, they're 1 a week, right? But like the YMAX, YMAG, that's just what came in through its holdings. We don't have to do any, definition on that. That's pretty well defined. LFGY, GPTY, right? The other, what I'll call the basket funds, Alti, those are also done on, by the way, those are a lot heavier lifting. It's not just one ticker in the rate, right? There's obviously much bigger baskets, longer periods, multiple options on, similar underlying. So those take a little more work, and they're weekly. But all that's done on Monday to be sent to the exchanges and announced on Wednesday morning, right? That goes out Wednesday early. So all of the press release has to get created, and all the approvals have to get done on Tuesday, and then Wednesday you see it, Thursday goes X, Friday you get the money.
Okay. All right. So question, I guess this is for Scott, and I know you've answered this previously. So you started, well, in the past, it was always you're writing, covered calls, credit call spreads on all of the contracts, all right, that the synthetic has. So the question is, why are you writing on some of them, right? And obviously we talked about that on the phone, but I'll let you answer the question too. Wow, we have 632 people now. So
yeah, this is a great question. So as you all might have noticed, the volatility in the options has decreased recently. So what we started to do 2 weeks ago was, you notice we only sold half as many contracts, but we were closer to at the money. So we received double the premium. So my first goal is to collect enough premium to be able to distribute in the dividend. So we only sold half as much, leaving all that upside on the other half of the fund. But giving up, we were closer to at the money. So our calls would go in the money sooner than they would. But that is the entire reason, is because the volatility dropped. Yeah. This last week, the makeup of the fund is different than it was 2 weeks ago. This week, we are 50% in call verticals, meaning we short a call and long a call, and with about collecting that 1.5% for the week in premium. Then the other 25%, we collected like that 3%, so closer at the money. And now we have 25% unhedged. So that's why there's less contracts unhedged in the combo this week, 25%. 25% of it we collected double on, 50% we did our normal. And we're adapting with what the market's giving us. So we're trying to make what the market is giving us to work to our benefit. And of course, if something happens, we're going to be aggressive in trading around it. Not on a Monday. I'm not going to try to trade on Mondays anymore.
Scott, I think we feel pretty good about that working out to our advantage last week, right? So as MSTR continued to go up and half the stock had no calls on it, we had already made kind of our income target for the week with that first half, and the other half was uncovered, and we actually Scott legged into other positions on the way up to generate additional income, right? So it might be a tactic you see a little more often from time to time when the conditions apply. But I think, Scott, you'd agree that worked out pretty well for us last week.
Yeah, I mean, Thursday and Friday, the last 3 weeks in a row, actually, the thing has just ripped to the upside. And Friday it opened at like went up to 430, then down to 405, and closed at like 415 or whatever. And yeah, we had sold some 410s the day before. Didn't know that it was going to pop up to 430. But yeah, overall it worked out. And I'll just tell you, here's my thinking. So this is something that I don't think we've addressed and told you guys. So when we're doing these vertical spreads where we're long one call and short another, if the stock appreciates and goes up, when our long call starts to become worth more than the premium left in our short call, we are going to roll that. So again, because this is a pretty key component of managing the short call spreads. When that long call becomes worth more in premium than what we have left in our short calls, we want to close that out and roll into a new one because we don't want to become long premium.
Yeah, so I saw, like you had, I think it was last week, like you said, you earned what you needed to, right, with half the contracts or 55% of the contracts. And then there was like a day you had like maybe it was 2 trades and they were kind of like really far out of the money. And I think they ended up working out, right? But it didn't matter, right? Because I guess you already earned what you needed to. So you had the flexibility to kind of do what you wanted for that trade. I forget what the strikes were. Do you know what I'm talking about? There was like 2.
Yes, I do know what you're talking about. So I was rolling to I was selling 420s. So I was covering our deep in the money calls. This didn't have anything to do with the long calls. These calls were just getting so far deep in the money that they didn't have any premium left. So it was basically took away any upside we had. There was no benefit to holding them anymore. But instead of going out to the next week, I was taking advantage of the premium that was left in the last 2 days and selling calls that were slightly out of the money and collecting like $6 or $7 for them. So I was selling those 420s and the 425s, covering our deeps that were totally in the money and only had maybe $1 of premium left. So that capped our upside. So by covering that, it unlocked all that upside. And that's again, my goal is to unlock all that upside while still being able to create enough premium to distribute. That's the challenge. But I think it's important to understand, like those long calls that we have, they do play sometimes and become worth something. I'm not waiting for them to go in the money. That's not the point of it. I mean, that if that happens overnight on a gap, that's great. But it's not like we're not thinking the stock's going to go to 475 or 480 today because we have those long calls. If the stock goes to 440 today, those are going to become so much. They're going to have so much premium. We're probably going to want to sell those and adjust the position.
Yeah, and the sooner you do, the better, right? The more valuable they are, more time value, right? They have left in them.
That's right.
Okay. This is I don't think anyone has ever asked this, or maybe they have in the past. Maybe a question for Jay. Do you see any institutions investing in MSTY, or just still retail investment?
It's still mostly retailer. We do see some independent advisors kind of adding it in and sprinkle it in. We also see hedge funds utilizing YieldMax as a tool. I actually think the largest single holder of Tesla, for example, is actually a hedge fund, right? So you do have some, if that's what you mean by institutional investors, then yeah, you have some professionals. So. It's still mostly day-to-day is probably, 80, 90%, retail folks, the do-it-yourselfers trading them. Yeah. It takes time for it to get adopted at the institutional level. And quite frankly, if I could touch on the risk aspect, I think a lot of advisors, aren't comfortable with having concentrated risk in MSTR, right? I mean, that's what you have with MSTY, right? I think I saw a question before. What would make MSTY go to $5? Yeah, if MSTR dropped by 80%, so would MSTY, and maybe it dropped like 75%, right? Well, but these are cover call strategies. You have long stock risk, right? You have risk to MSTR. Yes, you're getting a nice distribution. Yes, we're harvesting volatility, but make no mistake about it, you have risk in the underlying single stock when that happens. And, if it sells off, it's going to be, it'll go down when there's a sell off in the underlying.
Yeah. And I see the Colby put in there that Citadel held a bunch of shares in their filing. I mean, so I trade with Citadel every time I make a trade, or they have an opportunity to trade with us. So they will hedge with MSTY. So they might not be owning it. They might be owning it because it's a hedge.
I'm not sure how they're using it, but we love that they are.
Absolutely.
Yeah. And by the way, if you guys see questions that come up that you feel need to be answered, feel free to interrupt me and take them, because I'm, there's a lot and I'm trying to get to the good ones.
Doing great.
But this guy loves
first rodeo.
This guy loves you, Scott. So
this is my what I get up for in the morning. I mean, this is what I try to do every single day. And I'm
Jay, my neighbor. I don't know. You getting jealous, Jay, over there?
Just trying to
Scott. No, love it.
It's my job. It's what I do.
Yeah. So while I'm filtering through these, do you guys want to talk about MST and how the fund works? Since, obviously, it's a Defiance fund, but Title is doing the trading for. Is that correct?
Correct.
Okay. Do you want to give
Yeah, this is a new fund. It's a leveraged fund. It's it's a 200% exposure to MSTR, and then on half of that notional, we're selling calls for income. So it's kind of a combo of, let's say, MSTX, which is also a Defiance fund, and an MSTY. So I just talked about risk. If you want to take more risk, then MST is there for you to have more stock risk. So when I say at 200%, it's like a double leverage, right? A 2x single stock ETF, but we're selling calls for income probably in the same range that we're selling income on MSTY, right? It's not because it's double, we're going to make double. That's not the idea. We want to leave some of it uncapped. Actually, like what we talked about in the MSTY trading last week. Some of it's going to always be uncapped, and half of it will have a covered call that we're going to manage actively, that Scott and the team will manage actively. So similar. So, but again, if you want more, if MicroStrategy isn't volatile enough for you, then MST is going to get you double.
Yeah, and it's new.
It's new. Right? It's brand new, right? I mean, I think the fund has 25 million in it so far. Yeah, it's fairly new. A couple weeks.
Okay, this is interesting question. Well, it's been happening, right? The volatility is dropping. I guess they're asking how that would negatively impact MSTY, but I guess the yield would go down, right? Because you wouldn't strive for as high as the yield. If it's 100% IV, that's what you're going for, right? You're trying to pay out that yield. If the IV goes down to 50%, that's gonna, I don't know. I guess you're gonna you're going to strive to pay a 50% yield. Is that still
Yeah,
the
like
thing,
if
by the way?
the yield goes down to like an NVIDIA level yield at 50%, then we're going to sell options at 50%. You know, like the question we used to always get, and I think you remember this, right? It was like, how do you determine how much to sell each strike? And it's like, we're not using technical analysis to pick levels of which strikes to pick. We're letting the options market kind of tell us, right? What is the option market telling us the volatility is going to be? We use that number to define what our income rate will be. And then that forces where we're going to pick which strike to sell. Quite frankly, I mean, Scott will tell you that number works pretty well. There's nothing it's not even, 70% accurate, but how many days on a Friday, Scott, are you pegged right to the strike, right? It happens because the options market is telling you where like it's most likely to go in the next week or so, right? So we use that number, we let the options market tell us, and then we sell against that. You look at like an Apple or a Google, right? Those are much lower IVs. We sell strikes closer and we make a little less money. So as vol drops, we're going to sell for less income. And you may say, but Jay, last month was like a huge distribution while you're telling me vol was down at 75. Well, that has to do with the upside capture, right? So, MicroStrategy is a strange one in the fact that as it's going up, vol is going up. It's not normal. It's not unheard of. It happens in Tesla all the time. But generally stocks, the vol goes up as the price goes down because the fear factor comes in, right? Everybody hears the VIX and think it's the fear index. It's not. It's the speculation index. It tells you how much people are willing to put up to buy a long option on the north or south side of the underlying. With MicroStrategy, as it was kind of down and settling, vol dropped. As it's going up, vol's expanding. And by the way, it's expanding on the call side, not the put side, right? So what does that all mean? So that's a little technical, but it means speculators are willing to pay more for calls right now than they were 2, 3, 4 weeks ago, which is good for the fund, right? That means we can sell for more or sell at a higher strike price.
And I'll just add to that we saw on Friday when I was rolling, volatility, I think it went down to around 75 last week, but it's around 95 now. And it started to increase Friday afternoon. The out of the money calls started to go up. The stock wasn't moving or going down. Those out of the money calls were starting to tick up. And we noticed that on Friday, pretty big. So, and like Jay said, an MSTR happens on up moves. It's really interesting.
For sure. Yeah, I didn't know it's going up. I saw it going up a little. I know it was at 60 for a while, but it's good to see. Here's a question. I have to pull it up because thank you, Ant, by the way. And I saw multiple people bring this up. It's the correlation, buying MSTY, hedging it with WNTR. They're saying, is there anything, if they do both, is there anything to worry about? I know you really can't answer this, but do you have an opinion on this question?
Yep, for sure. So winter is not a perfect hedge for MSTY, right? So yes, it's bearish. So those who don't know, it's an inverse MSTY. So we're synthetically short, selling out of the money puts below. So instead of selling out of the money calls, we're selling out of the money puts on an inverse position. And you could say like, well, you got one up, one down. Well, if you get big moves and it goes through the strike on one of them, right? Like, and you start to cap your upside gain or your downside gain, one will continue to lose money and the other one will not make it up as fast, right? So if you could, if MicroStrategy stays between the strikes of the short strikes of winter, the short puts, and the short calls of MSTY, well, yeah, then in that scenario, you're neutral and you're earning the high dividend. That's great. If it goes outside of that, one way or another, down or up, then you're exposed to risk. Now, it's not one-for-one risk, don't get me wrong. And you'd have to do some regular rebalancing to keep your hedge active. Like this is a lot of activity here to keep, and it's fine. Like we encourage this if you think you know what you're doing. I love that people would use this. I mean, it's why we pushed to get winter out there in the first place. Like, I mean, I guess it couldn't have been a worse time, Scott, because MicroStrategy shut up, right? It's a bearish MicroStrategy fund, but it's still there. It's still going to do its job and continue to generate income. And when there's a pullback, switch. Right? I mean, that's why it's there. But I would never, in good conscience, can't tell anybody they're perfect hedges for each other at all. You will absolutely lower the volatility of your portfolio if you hold both. No doubt about it.
It's
right?
really an iron condor. If you hold winter and MSTY, basically your synthetics are going to wash and you're going to be short a put vertical and a call vertical, or puts and calls. So either a strangle or an iron condor, either way you want to look at it. But long term, probably not the greatest to hold both, but this can be done. Yes.
Thank you for that. And this is just a comment. Thank you, Jay, for allowing Scott to come out of his trading desk.
We let him out of the cave every once in a while. That's great.
And someone had a question, Scott, for you. Do you trade any other funds besides MSTY?
Yeah, trade them all. But no, we've got a couple of traders. We've got a team of traders that Jay and I oversee that we watch all day, every day. So listen, we talk every morning. We've got huddles. We talk all day, every day. We're together. It's a team effort on all the other funds for sure. So I'm in constant communication, Jay, with all the traders that are making decisions on every fund, on every trade.
Yeah, I mean, ultimately, right, Scott, as the SVP.
Ulti. We love Ulti. Yes.
Yeah. Oh, look, ultimately, with Scott as the SVP, he's trying to keep all of the funds operating as their targets, but it's impossible for one person to trade. What do we got? 60 YieldMax, 50, 48 YieldMaxes alone, not to mention all the other funds that we oversee. So there's portfolio manager levels below Scott, there's traders below that, right? So the infrastructure here is, I think Title's probably got the largest trading team as far as an ETF shop goes. There's over 30 people in my organization, right? And it's all dedicated to executing on all these strategies. But Scott is really there. Scott, I'll say this jokingly, right? But I was like, Scott, I want you trading, not trading. He goes, that's fine, but I'm trading MSTY forever. I was like, you can have it. It's fine. But it doesn't, nothing slips here. There's just a lot of bodies on these, and they're all being overseen and managed by Scott.
You can't tell a trader not to trade, right?
I actually like that he's still he's in touch. You have to know what are the market makers doing, what's happening on fill prices, how are those RFQs going, right? Where do we have to route? What's the trade execution look like? All that you can't, I guess you can read it in reports. Plenty of people do, but it's just better to be, touching and feeling it every day.
Yeah. No, I felt the passion when I talked to Scott the other day. I thought he was going to yell at me for, questioning his trades, but no, I felt the love for he's on the same, he wants to do the best and make the most for us. So it did come through.
I appreciate that. Thank you.
And again, it's kind of similar question as before, but I guess in general, you have all these inverse funds and the other, the covered call ETFs. Have you ever thought of a combo fund? I don't know if this question has come up, but I don't know, maybe 75% covered call, 25% inverse, or is that just kind of not something that's
look, I mean, the tools are there for people to create on their own. What I would tell you is we looked at what Scott said, doing condors instead, like running a YieldMax on condors. So the challenge with that, right, is we distribute the time premium that we make, right? If you distribute the time premium that you make on a condor, generally all that's left is the loss of the intrinsic move of the stock, right? So what would happen, it would be the NAV would depreciate even faster. Yes, the income would be higher, but we would just have to hold more back, and that hasn't ever been really the YieldMax way. All that would be left in the NAV were losing trades, and we would distribute all the winning trades of selling premium. So it would end up actually being, we looked at this pretty hard because it seemed like the natural evolution of once you've done the longs and done the shorts, it was a natural evolution of it. There's been others that have filed for it. Nobody's launched any because I think it'd be a pretty ugly NAV decay. What would happen from this?
Okay, thank you. Yeah, we're getting there on time. We have.
I know. Can I pivot for 1 second?
Yeah.
I look, because I know this is a MSTY focus. I just love though talking. One thing that I don't think we spent a lot of time talking about, those zero TTE funds that we launched a few months ago, the SDTY, QDTY, or DTY. Those are, if you like cover call strategies, like I would recommend people take a look at it. That's one of those strategies that we think we're doing something pretty unique in the marketplace. You see our daily trades throughout the day, right? You look at the end of the day. But if you look like now, you could see how active we're actually in those funds. And you could see where we're covering calls, rolling, putting strikes higher in up days, rolling down in down days. I would just say, take a look at those. I don't think you pay a lot of attention to those, but I'd love it if, we could do a spot on those at some point just to create some awareness where I
Yeah.
think we're actually doing some of the best trading in the market on those.
Yeah. Well, I do have a full-time job. Come on now. So, and Misty
Like we
trades.
know, right? I know.
But yeah, no, I haven't. They were part of I covered them on the weekend. I used to compare like the competitors.
Sure.
Once
Yeah, they're on competitors.
baseball
Sure.
season, so it's been kind of.
I know what you're doing in the stands. Baseball's kind of boring. Just be there banging out, performance reports in the
I'm
stands.
the manager. I can't be. I'm on the field.
All right.
So no, I know I haven't really looked into those funds enough, but no, appreciate you bringing that up too. But
Yeah.
I know usually at the end of the video, well, if you want to bring up something else, feel free. But
No, that was it. I just thought, I feel like those probably I think you would really like the way those are.
Yeah,
those are turning out. I just thought I'd mention it to you.
No, I do like how those funds are set up for sure. But do you guys have a question for the community that you want to see them answer? You have 706 people on here. So do you guys, Scott or Jay, do you have any questions that you want to ask the community?
Yeah, again, I appreciate all the dialogue on the frequency of dividends. Like as I read through this, the majority of folks so far that I saw were like 4 weeks is good, makes a lot of sense. I mean, there's been some funds out there that have talked about doing daily or multiple distributions each week. That may be something that we see at some point. Like, why not take it to extremes? Always love to hear people's feedback on that frequency. The other thing I would say when it comes to kind of product development, right? Like we have some, we talked about some of the baskets funds that are out there, like not Alti, but like the Target 12s, like Biggie, Soxy, recently Renty, RNTY that went out there. They don't get a lot of volume. And we're trying to figure out, like, does this community just like picking the single stock exposure? Or I'm trying to figure out why there's not a lot of volume in those. Or is it like 12%, you're supposed to be YieldMax, not yield meh, right? Like, what does nobody care about 12%, which used to be the best, right? Like that was it. Now that seems like it's low on the level, but do people not want a basket of portfolios, which they want the single stock? So I'm just trying to get a sense as to what the community likes about, the single stocks versus say the baskets, which arguably are more of an institutional product, right? It's more of a professional product, a theme, whether it's chips or it's, large caps or it's real estate. I think that's the only question I'd like. You like yield meh? Yeah, yield meh.
So what fund specifically did you mention you were surprised on the low volume?
Biggie, BIGY, Soxy, SOXY, Renty, RNTY. Renty's fairly new, but just curious.
Yeah, I don't know. I don't cover them obviously either, but they're very
YieldMax products, right? And they're really designed more as like portfolios and themes. Like remember, like the whole thematic thing, right? So just curious, like why they don't seem to have the interest of the retail community.
There's Max. He loves
cheap. Yeah, and I can tell you that until recently, I really had no idea that this huge community existed. So I appreciate what you do, Rod, Mark, and getting the real facts out there because there's just so much misinformation being thrown around. And like I said, I'm new to this and had no idea there was such a big community. But thanks for getting the real truth information out there.
Yeah, no problem.
Thanks, Max.
Work in progress. Yeah. Thanks, Max. It was
all you email, Max.
I didn't know the whole thing in the beginning either. Jay had to correct me on a lot of things, and I fully understood the fund. And I, Scott, when we talked, I learned a ton too. So it helps that I learn and understand the fund too, obviously as I go, because then I don't have to state things that that don't make any sense. But I'm not sure did you get your answer? I'm trying to pull up a bunch of the answers, Jay. You can always see them later.
Yeah, I'm scrolling through. Thank you, everybody.
Scott, did you have a question for the community or a comment or anything that we didn't cover that you want, the Reddit people, the Twitter X people, or the YouTube people to properly understand?
No, I'm good at this point. Thanks for having me. I appreciate it. I'm good.
Okay. Jay, good to go?
Good to go, man. Thanks. Great to be back. Great to talk to everybody.
All right. Yeah, no, thank you everyone for their participation. Thank you, Jay. Thank you, Scott, for joining. As always, none of this is financial advice. I'm not a financial advisor. This video is for fun and entertainment, right? Like the video says. But I'm going to end the video here. Hopefully we can have Jay and Scott back in the future, maybe on Twitter, maybe on here. I don't know. I'm venturing out now to these spaces as you've both seen, right? I know you guys are too, which is awesome because it's so much easier too. You don't have to turn the video on, but it's a good time. And again, thanks again for your time. If you could both hang on while I end this stream, we will go from there.
You got it. We'll wait. Thanks, everybody.
All right. Thank you, everyone.